The other term you need to understand that I'm going to talk about and I'll use in this video is the notion of being long and short. Long simply means you're a buyer. Short simply means that you're a seller. So those terms are used frequently in the market. The price in options known as the premium, and that's the cost of buying it. It's a one-time cost to the buyer. The other side of the coin is the premium is income to the seller. So what the buyer pays, the seller receives. What the buyer pays, moreover, has to be overcome in the market to get back that money. Again, take a Disney 25 April call. Let's say you pay 2 for the call. Now the market has to rise to 27 just for you to break even on that 25 call, because if you sell it in the market at 20, when the market's at 27, you get back your 2, but hey, you paid 2. So now you've broken even. Above 27, of course, you go into profitability. From the writer's point of view, the seller's point of view, he gets to collect the 2 regardless of what happens. So if the market expires, if the option expires when Disney's at 25, the option has no value. The seller gets to keep the money. If it goes up, the option writer or seller still gets to keep the money. However, as it goes higher, he's obligated to you, the buyer, to make good on that option. So at 27, he took in 2, he's out 2. At 28, he took in 2, he's out 3. At 29, he took in 2, he's out 4, and so on. And when I use the numbers 2, 3, and 4, of course, I mean $2 a share. They're standardized contracts, 100 shares in a contract. So 2 means $200, basically. That's the basic price. Now, in talking about the theory, I don't factor in commissions, but commissions are a legitimate cost that you do have to take into consideration when you're dealing with options. The potential loss, as I've mentioned, to the buyer of an option can be no greater than the initial premium, and that's why they say limited risk. Yeah, it's limited, but it's limited to 100%. It doesn't mean you're going to lose the 100% because, like I said, as long as the option's trading, it will have some value. And that's regardless of the underlying. Options are known as wasting assets. Now, this is an important aspect because they do not erode in value at a linear rate. In other words, they don't lose so much one month and so much the next month and so much right up to expiration. On the contrary, what happens is they lose their value over time as expiration approaches in a very slow fashion until they get up towards the expiration date, and then they erode value very quickly and they lose value quickly. This is important because when we get into the strategies, you'll see there's some options you can sell just prior to expiration, and they're going to lose their value rather rapidly. Typically, the expiration date is 9 months or less, though they have what are called their leaps, which are long-term options. And we're going to talk about time value. Do you want to buy an option with a short amount of time value or a longer amount of time value? As you go on in time, as you buy more time, it costs more money, of course. As time value erodes, the options are cheaper. The buyer of an equity call option has purchased the right to buy 100 shares. We've covered that of the underlying stock at the expiration. So, to take an example, the buyer of one XYZ, June 110 call option, has the right to purchase 100 shares of XYZ at any time prior to expiration. By the way, when you want to get out of the option, there's 2 ways to do it. You can simply go into the option market and sell your call, and it'll be worth whatever the value of the call at that point will be based on where it is in terms of the strike price. If it's in the money, in which case the strike price is lower than the market price, you'll get at least the value between the strike price and the current market price. In other words, if you have a 25 call and the market's at 30, you'll get at least 5. In practicality, you'll get more because there's so-called time value on top of the cash value. at expiration, you'll get exactly what the cash value is. Another word for cash value, of course, is intrinsic value. So the other option is not exercising, not selling the call rather, but rather exercising the call. Now, what does this mean? When you exercise, you tell your broker you want to exercise the call, in which case you will then buy the stock at the strike price. You can do this a day after you buy the stock, the option, the same day, or you can do it right up to expiration. It's up to you. The problem with that is now you got to come up with the cash to buy the stock. So you have an additional cost, and you also have an additional commission involved. You have to buy the stock and sell the stock, and now you've already paid for a commission on the call. So as a practical matter, most options are simply sold in the market for what they'll bring, as opposed to buying the underlying stock. Unless, of course, you want to own the underlying stock, in which then you can exercise and own it. And of course, you'll only do this if the option is in the money. So the buyer may exercise by filling in an exercise notice through his broker, and your broker will know how to do this. By the way, I owned some options not long ago, and we went right up to expiration, and the option was trading right around the strike price. And I thought, well, what's going to happen here? Is it going to expire worthless, or is it going to go into the money, and how will I know, and so on. So I called my brokerage firm, and I said, what happens if the option's in the money on the last day? Do you automatically exercise? And they said, yeah, as long as it's 1 quarter in the money at expiration, they will exercise the option automatically for you. Now, what happened in this particular case is we got down to the final trading day. The market rose. The value of the underlying stock went up. It went above the strike price, and the brokerage house now bought the stock. One problem, I didn't have enough money in the account to pay for the stock. No problem, they bought the stock on Friday afternoon, they sold it on Monday morning. However, over that period, if something had happened over the weekend and the stock had gone down, I would have had a loss on the stock position. They later wrote me a letter and said, don't do this where you don't have the money to buy the stock in your account. But they did it anyway, and of course they charged me a commission, and they automatically sold it out on Monday morning. All calls covering a stock like XYZ are referred to as an option class. Each individual option with a distinctive trading month in strike price is an option series. So the XYZ June 110 call would be an individual series. Another thing you need to know while we're talking about the basics here is when you first enter into an option, you have what's called an opening transaction. That means you're buying a new option and you're creating what they call in the market an increase of 1 on each option you buy in what's called the open interest. When you go to sell the option, your broker will say, is this an opening or closing transaction? So if you already own it, and you're selling it, then when you go to sell it, you say this is a closing transaction. Because what it does is it offsets the initial buy and then it ceases to exist. Now, if you're a writer of an option, you open by selling. And you hope that the option does not gain in value because that's your liability. And then when you go to buy it back, if you do buy it back to take profits, let's say it's gone down in value, then it's known as a closing transaction. Now let's talk a little bit about puts. Puts work in reverse of calls. Calls give you, the buyer, the right to purchase the underlying stock. Puts give you the right to sell the underlying stock. So the buyer of a put option has purchased the right to sell the underlying stock at the strike price at any time during the duration of the put option. This means the buyer of one XYZ June 50 put has a right to sell 100 shares at $50 anytime prior to expiration. Now, let's take a hypothetical situation. Let's assume you think a given stock is getting ready to rise. And I understand this is elementary, but it needs to be covered. In lieu of purchasing the stock, you can buy a call option as an alternative. This gives you the right to purchase the stock at the strike price any time prior to expiration. Now, in everything we discussed today, there's going to be advantages on one hand and disadvantages on the other. So you've got to know what they are. The bullish scenario is the right to buy the stock at a fixed price becomes more valuable as the price of the underlying stock increases. So on the one hand, you can buy the stock, and if prices go up, you make money on the stock. On the other hand, rather than buying the stock, you could buy a call option, and then you would have the right to purchase the stock at the strike. And as you'll see, when we get into an example here, you can get what's called more bang for its buck by buying a call rather than the underlying stock. However, the call has certain risks that owning the stock doesn't have. So let's say, for example, you buy a 50 strike call for 3.5. This 3.5, of course, translates into $350 on the single call option. Should the stock rise to $55 a share, the option would be worth at least $5. There'd be time value on top of that, but it would be at least $5. So now you paid 3.5, and the option is worth $5. And it would be worth a little bit more than $5 actually because of the time value.